Hello everyone, Professor Christensen here. Today's video is going to be an overview of Chapter 7, which is all about long-term assets. So let's take a look at what we're going to do. So in this chapter, really what we're going to do is we're going to look at the process of buying long-term assets like property, plant, and equipment and intangible assets and how we record the cost of those assets. And then we're going to look at what happens as we own the assets. So there's a couple things as we own the assets. One is expenditures after acquisition. So that's, if you have a repair or something like that on one of your assets. And then we're going to look at depreciation of property, plant, and equipment assets and amortization of intangible assets. And both of those are the recording of the allocating the cost of the asset over its useful life. And then finally, we'll take a look at what happens when we're done with the asset. So say it's a car and you're done with it and now you're going to sell it. All right, so our first learning objective is to look at the major types of property, plant, and equipment. And so there are really four major categories. Now remember that property, plant, and equipment down here, this is important, are long-lived assets that are used in the operations of the business. So for example, if you have land and that land is, you're holding it to sell it as an investment, that would be in another category called investments. This land would be land, for example, that your headquarters is on. So this land is land used in the operations of the business, okay? And land is pretty self-explanatory. Land improvements are things that you've done to the land that have finite lives. So remember, the thing about land that's unique of all property, plant, and equipment assets is that land is not depreciated. Land improvements are depreciated. So the thing with land is it lasts forever, right? It's not going to go away. But land improvements have finite lives. So these are things like fences, lighting, sprinkler systems, things, pavement, right? Things that are not going to last forever, and so they are depreciated, and those are called land improvements. Buildings, of course, a building could be a warehouse, it could be a factory, it could be an office building, any building that's used in the operations of the business. And then equipment contains a lot of different things. There are a lot of different things that can go in there. So, for example, it could be vehicles, trucks, cars. It can be computers, it can be cash registers, it can be machinery in a factory. It could be furniture, it could be fixtures in a store. So many, many different things included under equipment. And again, equipment is depreciated over its useful life. So the cost of property, plant, and equipment it includes all of the reasonable and necessary expenditures to acquire an asset and prepare it for its intended use. All right, this is really important because this is your guideline that tells you, oh, is this part of the cost of the asset or not? If it's part of the money that you have to spend to get the asset and get it ready for its intended use, then it's going to be part of the cost of the asset. So let's look at some examples of how this applies to some of the property, plant, and equipment assets. So land and building, when you buy land and building, the chances are, well, of course, you're going to have a purchase price, right? So that's going to be the contract. And then you might have to pay a lawyer. You are going to have to pay real estate fees. You might have to clear the land. So remember, you're getting the land ready for its intended use. So if you're buying the land to put a building on, clearing the land is part of the cost of preparing it for its intended use. So is tearing down an old building. So if you bought land and building, but it's an old building that you're not going to use, the cost of tearing down that building is part of the cost of the land, right? Preparing the land for its intended use. Back taxes or taxes from prior periods, those would be included also in the cost of your land and building. Now, equipment is different, but of course equipment, you're going to have a purchase price. You're probably going to have to pay sales taxes. You might have to pay shipping costs depending on where it's coming from. You might pay insurance in transit, and you might have to test the equipment, and you might have to pay to install it. So all of those costs are going to be included as part of the cost of your equipment. So remember, Sometimes students study this, but they forget. What does that mean? It means when you pay those monies, you are debiting equipment, right? You're not debiting insurance, you're debiting equipment because it's part of the cost of your equipment. Same for all of those other things. All right, so there are a number of different intangible assets. Some of the most common ones we have here. A patent, I think probably most of you are familiar with these, but if not, I'll tell you a little bit about them. The patent is, so let's just look at the what an intangible is first of all. Remember, intangible means you can't touch it, so it has no physical substance. And these are usually contractual assets. So patents protect either an idea, a process, or a product, right? So for example, of course, your cell phone is patented, right? An iPhone has a patent on it. The computer that you're looking at this on has a patent on it. And so that is protected by patent law. Trademarks, think about the golden arches, right? Think about a Starbucks logo or any other logo of many products that you're probably familiar with. Those are trademarks, so you cannot use those legally, right? Copyright is a way to protect either books or music. So reasons why you can't just take a photocopy of a book and sell it to somebody else. That would be illegal. Franchises, again, we'll go back to the golden arches, right? Franchises, most people when they hear franchise, they think of McDonald's for some reason, but a franchise means that you paid a fee in order to run that franchise, use the name, and be able to buy their products. And so that franchise fee is what would be included in franchises. And then we have goodwill. Goodwill is kind of a very amorphous kind of intangible, maybe the most intangible. So goodwill means that the company that you're looking at bought another company. And when it bought the company, it paid more than the net assets of the company. So net assets are assets minus liabilities, right? So let's say you are the owner of a local bike shop, and you have a business that's been there for many years. You've been there for 25 years. You have many, many loyal customers. You have a great location. You have a great parking lot. You have great employees that know a lot about bicycles, and people like coming to your store. So when you sell your store, let's say you have assets of, let's say, $500,000 net assets. Somebody is going to pay you more than the $500,000 to buy that bike store because they're paying for all of the things you've built up over those 25 years, the customers, the reputation, all that. So if you see goodwill on a balance sheet, that means that that company bought another company and they paid more than the value of the net assets for it. Okay? So that's what goodwill is. Don't get it mixed up with goodwill that you know, the Goodwill store, right? Because the Goodwill store is totally different. There's a lot of things in accounting that have different words than the way you use them in other areas. All right, so next we'll take a quick look at the accounting of expenditures after you buy an asset. So either we're going to capitalize them, which means we debit the asset. When you capitalize something, that means you're putting it into the cost of the asset, or you expense it, which means you're debiting an expense. So we capitalize things that benefit future periods. So the example here is an addition that's made to the building. So if you add an addition onto your building, of course, that's going to benefit future periods. And so you're going to debit building for that. An expense would be something that only benefits this period. So that's something like, say you get an oil change on your truck. Well, you're going to have to do that again next period, right? So that is not going to get debited to the truck. That's going to get debited to repair and maintenance expense account, right? So that would be an expense. So next, let's take a look at depreciation. Now, there are 3 different videos in your guided notes that will help you with depreciation, okay? So remember that, so you already know a little bit about depreciation, right? When you record depreciation, you know that we debit depreciation expense and we credit accumulated depreciation. And depreciation, remember, it is, again, the word means something different in accounting. It is the allocation of the cost of the asset over its useful life, right? It doesn't necessarily mean that the asset went down in value. You could have a building that went way up in value. You're still depreciating it. You're allocating its cost over its useful life. So there are three different ways that we're going to look at depreciating assets. I want you to focus on straight line because over 90% of companies use straight line depreciation, right? But we're going to also take a look at an activity-based method and double declining balance. So a couple of terms that you want to be familiar with. Depreciable cost is the cost of the asset minus its residual value. So residual value is the amount that the asset will be worth, the estimated amount it will be worth at the end of its life. So think if you bought a car today and you kept it for 5 years. Well, at the end of 5 years, you're going to be able to sell it for something. And that something is your residual value, right? So if you buy a car today and you estimate, well, 5 years from now, this car is going to be worth $15,000, the $15,000 is residual value. We don't depreciate that. We only depreciate the part of the cost that we actually have to pay, right? So depreciable cost is the cost minus residual value. And book value, this is just a reminder because we learned this before, remember. Book value is the cost of the asset. And remember, we just talked about cost, how you come up with cost, right? The cost of the asset minus accumulated depreciation to date. Remember that what happens to book value over the asset's life? It goes down, right? Because the more you depreciate, your accumulated depreciation goes up and your book value goes down. You can tell the age of a company's assets by comparing the cost of the asset to the accumulated depreciation. If the accumulated depreciation is almost as much as the cost, then that means that they better have some money put aside to buy some new assets soon, right? Because they're getting old. All right, so straight line depreciation, I said, is the most common, and it results, you'll see why it's the most common because it's the simplest. You have the same amount of depreciation every year, unless you have a partial year, and in that case, you have to multiply it by a fraction of a year. But generally speaking, it's the same amount every year, and your formula is the cost of the asset minus the residual value. Remember, that's called your depreciable cost, divided by the useful life of the asset in years. So basically what you're saying is take the cost, divide it by how many years it's good for. That's our depreciation each year. All right, activity-based depreciation is different because every year the amount is going to be different based on how much you used the asset. So it's going to fluctuate. The depreciation is calculated in two steps. So first we calculate depreciation rate per unit. So say you have a car and the car is going to be driven 100,000 miles. Well, that would be the useful life of the asset in units, 100,000 miles, right? And remember, in the numerator, it's the same as before. It's depreciable cost, cost minus residual. So then you have your depreciation rate per unit, so say per mile. Then you have to find your depreciation for the year, and that's equal to the depreciation rate per unit times the number of units that you used up or you made. So here you would multiply by the number of miles you drove the truck. Now the third method of depreciation is called double declining balance depreciation. And this is what's called an accelerated depreciation method. It records more depreciation in the beginning years of the asset's life and less in the later years, the theory being that the asset is more productive at the beginning of its life. The way you calculate it is you multiply the book value of the asset at the beginning of the year times twice the straight line rate. Again, remember there are some depreciation videos. There's one that's called 3 depreciation methods. That's the one that shows you how to do double declining balance. One thing you want to remember with double declining balance, you don't deduct salvage value at the beginning. Remember, or residual value, right? Salvage and residual are the same. Remember that both these other methods, cost minus residual, here you don't deduct your salvage or your residual. You depreciate down until you hit your salvage and then you stop. Okay? So Intangible assets are not depreciated. They are what's called amortized. And it's a little bit simpler with intangible assets. It's the same process. You're allocating the cost of the asset. It has to be an intangible with a finite life, so one that's not going to last forever, like a copyright or a patent. We only use straight line with amortization, and generally there's no residual value, so it's pretty easy. You're just taking the cost of, say, the patent and dividing it by its useful life, and that gives you your amortization. We also don't have an accumulated amortization account. We just debit the account directly. So if you were debiting the patent, you would debit amortization expense and you would credit the patent directly. The last thing we're going to take a look at is accounting for the disposal of the long-term assets. Remember, we mentioned the car. So maybe you have a car, you keep it for 5 years, and you decide you're going to get rid of it, or machinery, or a truck, right? So here are the steps that you're going to go through. And again, this is in your guided notes that will help you, and there are some examples there. So the first thing you have to do is update your depreciation. And the reason for that is that you have not recorded depreciation since the end of the last accounting period. Because remember, depreciation is an adjusting entry. It only happens at the end of the period. So first thing you do is you update the depreciation. So that means you record it for the time since the last time you recorded depreciation. So say you're selling an asset on March 1st and you last depreciated December 31st. So you have to record depreciation for January and February. Once you have your depreciation updated, you're going to prepare a journal entry. You're going to remove the asset from the books because you're selling it, right? So you're going to credit the equipment or credit whatever it is. You're going to debit the accumulated depreciation because you're getting rid of it. So you're removing the asset, you're removing the accumulated depreciation. That's for every single time you dispose of an asset, right? Because the accumulated depreciation has to come out, so does the cost of the asset. Then you're going to record any cash received. Now, it could be you're just throwing it out, or you're disposing of it, right, or retiring it. So you're not getting any money, but it could be that you got some money. So if you got money or you sold the asset, you're going to record the cash. And of course, that's a debit because that's cash coming in. Then you were going to record a gain or a loss. And again, look at your guided notes for a little bit more detail on gains or losses. The gain or loss is the difference between the book value of your asset on the date of the sale and your selling price. All right. This can get a little messy, so you might have to spend a little time with that. So take a look at it. It's the difference between the book value and the selling price. Finally, I always say to check that debits equal credits, because when you make these journal entries, you might have 3 or possibly 4 items on your in your journal entry, so you want to make sure that your debits equal your credits. All right, so that's all I have for now. Good luck with this chapter, and I will see you next time.